Alrighty, folks. So this is the ninth video on accounting, and it is the first video on the Maybe series. And I would say that in terms of the topics to learn in the Maybe series, accounting is probably the most important one, right? The other ones are still important, but particularly for the Maybe series, it's the most important one. Overall, obviously, as for like my earlier videos, I would say it's not incredibly important, but at this point in kind of your learning, I would definitely say that accounting should be your priority. So what we're going to do in pretty much all of the accounting videos in this section for the Maybe series is that we're going to be looking at what happens to the three financial statements when a particular event occurs, right? So we're going to look at our income statement, we're going to look at our balance sheet, and we're going to look at our cash flow statement, and we're going to basically figure out that if a particular event happens, what happens to each one of these three statements, right? So I'll start off with kind of easier examples, and then I'll get into like the more complex examples as we move on, right? So let's talk about the first example, right? And that is what happens if our revenue, right? So I'll write it in the top left. What happens if our revenue increases by $100, right? So if you guys remember, right, on our income statement, what does it typically look like, right? We have our revenue, then we have our costs of goods sold, that gives us our gross profit, then we subtract out our operating expenses, then we get our EBIT, right? Then we subtract out our interest, that gives us our EBT, or our pre-tax income, then we subtract out our taxes, right? And that gives us our net income. Our balance sheet is essentially our assets, right? Oops. Then we have our liabilities, then we have our shareholders' equity. And we know that our assets are equivalent to our liabilities plus our shareholders' equity. That's what we've covered in some of the earlier lessons, right? And we know that our cash flow statement starts off with our net income, and then we're going to look at all of the adjustments for our cash flow from operations, then all of our adjustments for our cash flow from investing, and then all of our adjustments for cash flow from financing, right? So that's the general structure of our income statement, our balance sheet, and our cash flow statement, right? So let's hop into an example of what happens when revenue increases by 100, right? So let's work on a clean slate here, right? So we have our income statement, we have our balance sheet, and we have our cash flow statement, right? And what we're saying is that revenue is going to increase by 100. Well, if revenue increases by 100, then obviously our revenue line item on our income statement is going to increase by 100, right? That means our cost of goods sold is just flat, no changes there, meaning that our gross profit is also going to be increased by 100, right? Our operating expenses, stayed flat, meaning that our EBIT is also up by 100. Now our interest expense there's no change there. So earnings before taxes are just going to be up by 100. Now our taxes, and this is what we're going to subtract now, we are going to have to pay more in taxes, right? So let's assume that there's a 25% tax rate. Well, if we have $100 more, that $100 is going to be taxed at 25%, meaning that our taxes are actually going to go up by 25, right? So that means that our net income overall goes up by 100 minus 25, so it's up by 75, right? So over here, we know how this $100 increase in revenue is going to impact our income statement. What I always want you guys to do whenever you're walking through any of these is first you're going to talk about the income statement, then you're going to talk about the cash flow statement, and then you're going to talk about the balance sheet. And the reasoning for that is on our cash flow statement at the end, we figure out what the change in cash was, right? What is the change in cash? So that is a line item on our balance sheet, right, under our cash balance. So that is incredibly important to know when we're walking over to our balance sheet. So for every single problem, start on the income statement, then on the cash flow statement, and then we'll talk about the balance sheet. So we know we just walked through our income statement. This flows directly to the top of our cash flow statement, right? So we know that our cash is up by 75 at this point in time, right? Now let's think, do we need to make any adjustments on our cash flow statement? The answer is no, right? All you did was have $100 more in revenue, meaning that your net income increased by 75. Essentially, you made $75 of profit. So you're going to have $75 more in your pocket. We didn't use that $75 for anything. If we did, then yeah, sure, we would have to adjust something here. But all we did was we just got $75 more cash sitting in our pocket. So overall, our cash is going to increase by 75. That flows through directly to our balance sheet right here. So our cash balance is going to be up by 75. And remember, our net income right here doesn't just flow to our cash flow statement, it also flows to our shareholders' equity. Because the way that I want you to think about it is that if there's $75 more in profits, who is that attributable to? That's attributable to the shareholders of that company. So that means that our shareholders' equity also goes up by $75, right? And that's essentially all there is to it, right? We had $100 worth of revenue. After taxes, we had an increase of $75 to our net income. That flows through to our cash flow statement. So we have 75 more dollars, right? That's going to lead to us having $75 more in cash. That cash is going to sit on our balance sheet as a cash balance. And that net income flows through to our shareholders' equity. And the biggest thing, how I would always end these answers, is that our assets, right, they're up by 75, right? And our shareholders' equity is up by 75, meaning that if we have our assets, which equal our liabilities plus our shareholders' equity, if our assets are up and our shareholders' equity is up, then this equation right here balances, right? So that's essentially a check that I would always do. So if I was to walk someone through it, I'd say that a $100 increase in our revenue will first start off on our income statement. So we're going to have $100 more in revenue. So essentially our pre-tax income is going to be up by 100. At a 25% tax rate, that means that our net income is going to be up by 75. That flows through to our cash flow statement, and there's no adjustments to be made on our cash flow statement, so our cash is simply increased by 75. That flows through to our balance sheet, and on our balance sheet, our cash is going to be up by 75. Our shareholders' equity is going to be up by 75 because that's what's attributable to our shareholders, and our balance sheet balances because our assets are up by 75 and our shareholders' equity is up by 75. Now let's look at the next example. let's say that our expenses, oops, I really can't spell today. Our expenses are up by 100, right? So let's look at the three statements here again. This is actually a pretty similar problem, right? So we have our revenue, that's going to stay flat, right? Our cost of goods sold is going to stay flat, meaning that our gross profit stays flat. Now we're going to subtract out, right, our operating expenses, right? Now we have more operating expenses, right? So our operating expenses increased by 100, meaning that our EBIT has actually decreased by 100. That makes sense, right? Our earnings are going to go down because we incurred an expense. Our interest is going to stay flat, meaning that our pre-tax income is going to be down by 100. And now let's look at our taxes, right? And in all of these questions, you can kind of assume a 25% tax rate unless they explicitly tell you otherwise, right? Well, for your taxes, you made $100 less because you have these expenses, right? So that means that you're going to pay 25% of 100, which is 25, less in taxes, right? Because that is $100 that you essentially didn't make, meaning that because you didn't make that money, you don't have to pay taxes on that money. So because we recognized there was an increase in our expenses, we recognized $100 more in expenses, our taxes are actually going to be, oops, down by 25, right? We're paying $25 less in taxes, right? So that means that our net income is going to be decreased by 75, right? So honestly, for taxes, you don't really have to think of it as, oh, they're $25 less in taxes. You can just think of, oh, our tax amount's going to be $25 less, right? I feel like the arrow is a little bit confusing here, right? That's essentially the way that I would go through the income statement there. Now, what do? We go over to our cash flow statement. Our cash flow statement, we know that our net income is down by $75. And if our net income is down by $75, we now have to see, are there any adjustments that we need to make on our cash flow statement? Did we buy anything? Did we sell anything? Like, is there anything that we need to like essentially adjust for? Did we invest elsewhere? Did we make some like weird financing decision? No, we didn't, right? This is a really simple example. So that means that our cash is simply down by 75. Now on our balance sheet, under assets, we have our cash balance that's going to be down by 75 because essentially we incurred an expense, right? And for our shareholders' equity, there is $75 that are no longer attributable to our shareholders' equity, meaning that our shareholders' equity went down by 75. And let's check our golden rule here. Assets equals liabilities plus shareholders' equity. Well, if assets are down and shareholders' equity is down, this balances, right? This checks off. So that works perfectly. That means we walk through this example correctly. So the way that I would walk someone through this in a coffee chat or an interview would be that, well, if our expenses increased by $100, then I would jump straight to our pre-tax income here. That would mean that our pre-tax income is down by $100. However, we're going to save some on taxes, so our net income is actually going to be down by 75. That flows through to our cash flow statement, and there's no adjustments to be made on the cash flow statement, so our cash is simply down by 75. That flows through to our balance sheet, so our cash balance is down by 75, and our shareholders' equity is also going to be down by 75. And overall, because our assets are down by 75 and our shareholders' equity is down by 75, the balance sheet balances. So that's kind of how to walk through expenses and an increase in revenue on the three financial statements. This is the kind of simplest example on the walking someone through the three financial statements with a particular scenario. So this is a really good place to start, and it's a lot actually easier than the depreciation question that is asked pretty commonly. But I really think that this is a good kind of foundation for you to get into some of these more advanced topics. So that's yeah, that's walking you through a revenue and expense line item on the three statements. So I hope that's been helpful.